How's it going, everybody? Antonio here for some resource talks. In this one, I was joined by Adam Rozencwajg. He's a portfolio manager who currently manages over $400 million. What I'm about to show you here is just a short clip from the whole conversation that I had with him. In this part, he walked me through his portfolio, and then we talked about uranium, lithium, copper, and a bunch of other stuff. And during the full conversation, we talked a little bit more about him, his portfolio, and how he thinks about stuff. We even talked about he talked about his outlook on the capex cycle in the commodity space. We talked more in depth about coal, natural gas, and some other things as well. It was a very interesting conversation, to say the least. So if you're interested, head over to resourcetalks.com. It's also going to be linked in the pinned comment or in the description of this video, wherever you can find it. Go there under the tab interviews. You can listen to that conversation or download it. It's completely free. If you want, you can even join our Discord server over there as well. We get early access to these interviews, or simply keep an eye out on that website if you don't want to join our Discord servers. That's where interviews get published unedited, in full, and earlier than they do on here. All right, here's Adam. You don't have to get specific with me because I'm hoping we can talk about each one of the resources you're holding right now a bit more in depth in sort of the second part of the call. But what does your fund portfolio breakdown look like roughly right now in terms of percentages?
So we have a very high conviction view on oil and gas. And so we have about 42% of the fund in oil and gas. We have another 16 in uranium. We'll talk all about that. And then we've been adding to our positions in copper and gold. We've been very bullish on both of those for quite some time. However, we took down our exposures from basically peak maximum exposure back in the summer of 2020 in order to free up some proceeds to invest in oil and gas. And that was the right call. I mean, no two ways about it. If you look at gold and copper in the lead up to 2020, they massively outperformed energy. And then that reversed beginning in the third quarter of 2020. So it's not that we wanted to stay away from those areas, but we did see the relative value opportunity in energy. We did feel that the fundamentals had basically gotten even more bearish in energy than they were in mining. And so that's why we really allocated more to that space. But now, after last year in particular, where the average energy stock was up 60 and the average mining stock was down 15, we felt that the time was probably getting closer and closer and closer to wanting to increase our allocations back towards some of the metals and miners. So not that we're bearish on energy by any means. It's still our biggest position, our two biggest positions, three, I guess, if you count uranium. But on the margin, we are adding to our metals names as well.
We've got about 15. I mean, you have about 15 minutes here, and I don't want to. I hate to cut off the topic like that, but I was looking at the exposure that you told me about at the beginning, where you told me that you're about 16% in uranium. You just told me about 25% natural gas and 42% oil. Oh no, you told me 42%
oil and gas together.
Okay, so if I had to do some math here, I'd probably get that. But why would you be more bullish on natural gas than on uranium? Is, I guess, what I'm trying to ask here.
So I think that I don't know that I would call us more bullish. I mean, maybe we are a little bit, but a core theme for us is about 20%, give or take, of the portfolio. So it'll be 20% ish, and we could maybe as high as 25%. So I would call natural gas a core thematic weighting. We've actually, believe it or not, been reducing, like I said, our gas exposures a little bit, just to be able to free up some capital to move into the copper names and the gold names, which we can talk about. But that still represents a really core position for us. Uranium, I would call a core position also. It's a bit shy of 20%. And so the difference, if you had to rank them, I suppose we're more bullish on natural gas, but we're very, very bullish on uranium as well. And we became bullish right at the bottom when uranium was $19 a pound at the end of 2018. That's when we established all of our positions there. That market's going to play out over the next several years. That's not going to. People are really fixated on the short term, and someone always asks me, "Oh well, the uranium names haven't been doing anything here," and then they'll come back and say, "Oh, the uranium names are ripping. What's going on?" The truth of the matter is, to us, this is like a 5 to 10 year trade, because what's ultimately happening here is we have not invested in a new uranium mine for 30 years. In fact, most uranium mines at the bottom, even the two major primary uranium producers, Cameco and Kazatomprom, both shut down their flagship mines at the bottom because even though they were a duopoly, they couldn't make money on a cash basis. That's a really bad bear market. And as a result of that, nothing's been brought online in a really, really long time. At the same time as that's happening, China's undergoing a really big new reactor build program with capacity coming on last year, this year, and basically every year through the 2030s. And that'll tighten the market dramatically. So I think that uranium prices will do very, very well. But, this is not a quarter to quarter story. These sources of demand are big, they're sticky, but they take a long time to come online. And, I would use any opportunity of weakness to add to those positions. And I think that when you look back in 2030, uranium and nuclear power hopefully will make up a much bigger percentage of the global energy mix than they do now, which they really have to, because that's the only way that we can possibly reduce CO2 and do it in an efficient manner.
Absolutely agree. You make a very good point that not too many people make, that this is a much longer term trade than most of us might have expected, including me at the beginning when I was getting in. And you start looking at some of these contracts that Cameco is signing and extending with Bruce Power. We're talking contract 2017 through 2040. Like, what do these contracts happen? Uranium, right? Other places, these contracts don't happen like that. So that makes you think how long of a term this sector really is. But
no, absolutely. It takes a long time to build capacity. Once it's up and running, the cost of uranium in the total cost of electricity is de minimis. So prices could double, triple, quadruple. No one's going to stop buying if they don't have to. The only question that I find curious in the uranium industry is, given the whole dynamic, I don't know why these traders wait as long as they do. It's like picking up proverbial pennies in front of a steamroller. If you're wrong and you have a huge uranium nuclear power plant that's inoperable because you haven't been able to get fuel, that's catastrophic. And so it really doesn't matter what you pay. And obviously you don't want to overpay, but to see uranium prices go from 145 down to 19 and not have any utilities willing to contract at 19 seems quite foolish to me in retrospect.
Sure does. A lot have been picking up on the spot market, the secondary market, is first time we're hearing it, but you cannot rely too much on it. So it seems like contracting is picking up right now, though. It seems like 2023 is on track to see replacement rate contracting. So that might be a good year for us.
So agreed. First time that happened in a long time.
Oh, absolutely. Over a decade. Yeah. No. Yeah. Fukushima, right? That's when the last time they were doing a replacement rate. So yeah, it makes sense. Well, what do you do though? As again, in my opinion, relative to the money that I manage for myself, you manage a lot of money. I mean, if you want uranium exposure, would you have 4 options? So it'd be Spud, Kazatomprom, Cameco, BHP for that Olympic Dam exposure. But what do you do?
Yeah, it's tricky, isn't it? So if you look at some of our holdings, Cameco and Kazatomprom are larger than some as single holdings, or larger than some of our oil and gas holdings, precisely because there's not a lot of good alternatives there. So we have to be a little bit more concentrated. We have added to a few of the development stories. So like the way we like to think about the world is we say, okay, if we're right on the commodity, we want to make sure we're in names that'll get good exposure to that upside. If we're wrong on the commodity, we're willing to accept stocks that go down, but we don't want them to permanently impair their capital, meaning like we don't want companies that are worthless if we're wrong. So if uranium prices go down, they're $50 today. If they go down to 30, Cameco is not going to be a good stock, but it's not going to go out of business. As long as you need nuclear power, you'll have Cameco. Same thing with Kazatomprom. A name like, we own NextGen as well. So a name like NextGen, if uranium goes back down to 19, I mean, that project doesn't have any value. It has option value, I suppose, but it's not built yet. It's not developed. And so if we're wrong there, that'll have a bigger impact. So when uranium prices came off the bottom at $19-20 in 2018, we didn't own anything like that. We owned Cameco and Kazatomprom and the old uranium participation unit to round out our exposure. But as we felt that this bull market was a little bit more sustainable and that it would last, we said, okay, we'll be willing to make a little bit of a reach here and buy what we think is the best quality new development story. And in our estimation, that's next gen. So we own next gen as well. So we own a couple of the development stories at this point, and we're kind of trying to pick them off in order of what I think are the most robust projects, realizing that if we're wrong on the commodity price and uranium prices collapse again, those names will, suffer much bigger losses than a Cameco and a Kazatomprom because they don't have any cash flows. And if uranium prices fall, they might not ever. So we size them smaller. We let them be kind of, more speculative upside, if you will. And we try to be very, very cautious at owning only the best ones.
Mm-hmm. Besides next gen, are you also looking into some of the African development stories?
Yeah, we look at everything. I think you just kind of layer on risk over risk over risk, and we own other assets in Africa, so Africa is not a no-go zone for us by any means. So we look globally. As of right now, most of our holdings are in North America and Kazakhstan.
Mm-hmm. Do you guys visit projects before
you?
Okay.
Absolutely. Yeah. We love to visit projects. We love to go on site, go underground. We've been all over the world. Lee's been to pretty much every major mine in the world, and I've been to probably a third of them and growing. So yeah, no, we love to get on site. It's a big part of what we do.
Give me something spicy on uranium that I might not experience through my desk research.
Oh, I don't know. I think, one of the things that I think is interesting, not necessarily on uranium, but on the demand side of things. A couple years ago, when everyone started talking about these small modular reactors, it started to really bug me because I was quite convinced that no one had any idea what they were talking about. And I think that's basically right. Everyone says, oh, yeah, these small modular reactors, they're going to be great. And one of the things that had bugged me at the beginning was that it's very rare in energy that small is better than large. There's usually really big economies of scale in the energy business. That's why you see these big power plants and big offshore rigs and stuff like that. So I was like, okay, well, why would that be the case? And so we spent a lot of time and effort getting to know a lot of the different technologies over the last couple of years. And the more that I've done that, the more enthusiastic I have become about some of these small modular reactors. Not all of them, though. I think some of them are compelling, but not enough that they're going to move the needle, but some of them really are. And there's some really, really interesting new technologies out there, particularly the ones that use salt instead of water as their coolants. And I think that as a result of that, we're going to have a generation of nuclear reactors that are much cheaper, that are very, very safe. I don't want to say much safer because even the third generation facilities are incredibly safe, but I do understand conceptually why these ones will be even safer still, and generate far less waste. And so I think that if we, can keep our heads screwed on straight and continue some of the clear thinking on nuclear power that we have done in the last 2 years, we could be in store for some really exciting future for nuclear power.
I agree with you there. You like oil and gas, you like uranium, you're adding to your gold and copper positions. What is something you don't like? Like if you look at the commodity spectrum, like lithium, or I don't know, something like that.
Yeah, there's lots of stuff we're not as keen on. We don't own any lithium. We don't own many of the battery metals, although that lithium, I think, probably is the one where we feel has the most potential for really severe disappointment. And the reason is really this, everyone puts out this chart and they show lithium demand, which hits this hockey stick and, goes up by a gazillion percent. And then supply they show has gone up, 2-3% in line with demand. And then they just kind of have like a question mark after demand does this hockey stick. And the implication is that supply can't keep up. And the truth of the matter is we don't really know. We kind of tell the lithium industry how much to produce every year. I mean, I'm joking a little bit, but it doesn't have an inherent supply constraint to it. We've always produced as much as we think we'll need as an industry. In some years we produce too much, in some years too little. But in general, we've been able to keep track and keep pace, even with really strong demand. And so I think there's this view that as batteries adoption grows, which we could argue with, but fine. There's no way to keep up with that demand. And I just don't think that's true. And so I think what is most likely is a period of intense volatility for lithium, where some years we are undersupplied. And so prices, triple. And then other years we're a little bit oversupplied and prices fall by 75%. And that's basically what we're seeing now, like we've been saying that for a while, but that's basically what's played out. So you'll get deficits and you'll get surpluses, but they won't be a structural deficit in the same way that, let's say, copper is. And so I'd be very, very reluctant to really commit a lot of, our investors' capital to that type of a theme, because I don't think it has the right longevity. I just don't know how it plays out. So that's one. I'm trying to think something else. Right now, we don't have a lot of exposure to steel or iron ore, for instance, and that had a huge, massive capital spending boom in the last cycle. Now, I think there could be some changes in the steel industry that are coming that could be interesting to kind of think about from an investment perspective. But if you look at iron ore, iron ore had a ton of money spent on it. That's the other thing with lithium. Lithium, from a capital cycle perspective, is not where you want to be. Money's just pouring into the lithium space right now, and so I don't think that bears well going forward. I'm trying to think what else. Anything else?
Yeah, something like eggs. It was overextended. A lot of capex going into it too. It's good that you're mentioning copper has longevity. I don't think anybody can disagree with you there. The IEA published a report about demand for copper doubling by 2030, but us physically not having the ability to find, permit, build, and mine enough copper by then to cover all that demand. Yes. So that's 70 years away from now, sure. There's going to have to be a capex boom there as well. M&A seems to be heating up with tech, with Copper Mountain, Hudbay, and so on and so forth. But so the long term, I get the long term path of least resistance, I guess, for copper is up. But what about over the short run? Because you said you're adding right now, and I'm just curious, why now? Because what I've been noticing, you tell me why I'm wrong, but I've been noticing, protests or the blockades in Peru are starting to lift up, and so companies have stockpiled material there that will have to find its way through the market this year. We have China's March year-over-year import of copper falling 19% reported last week, while their domestic production was reported up 14%, if I remember correctly. And we have fears of a global slowdown in the economy over here in the OECD part of the world, OECD part of the world. So why are you adding to copper right now? Why not wait?
Yeah, well, because I think you could wait. I think the risk is that, I suppose, you don't get the big pullback and you end up missing the move. And then the question is, what type of an investor are you? And will you chase that, or will you say to yourself, oh, darn it, I missed it, and then you'll hold back and then it'll keep running away from you? So I think when we look at the fundamentals, what we see in the copper side of things is, on the positive, on the demand front, I think we're going to be in a really positive spot for an ongoing basis. And I would use any weakness or temporary dislocations there again to add. That's just the way that we like to think. We're long-term investors, right? So we like to look and we say, look, these are the fundamentals. I'm almost sure that they're going to take place over the next 5 to 10 years. And so then anything that's going to happen, like a weather event or like, a weak China print or something like that, and you get a sell-off on these names, buy them, bring them back up to your target weights. And that's why we're not at a 25% weighting in copper just yet. We are legging into it not because I'm worried about the fundamentals, but because I'll be the first to admit that we're not great on timing. And so if you're not great on timing, the best thing you can do is to try to open up your target area there and, do some dollar cost averaging. It's like really sophisticated stuff there, but there you go. Looking at the copper side of things in particular, I think that India, in the next short period of time, yes, I hear what you're saying on the China print in this last weekly number, but the Indian numbers have been staggering and they've been really off the charts. You're talking about Indian copper demand up about 30% year on year in some months, some readings. And one of the things that's kind of been interesting, this could be a short-term data point, but going all the way back to 2018, we said, look, what's going to drive the copper market here going forward? And we said it's ultimately going to be demand. And you have three main sources of demand. You have the fact that renewables and electric vehicles are super copper intensive. You have the fact that China, despite everyone thinking that it's overconsumed copper, really hasn't. We like to look at things, how much copper needs to be installed in an economy for an economy of its size. So an economy like China's, where about $12,000 per capita GDP, should have about 100 pounds of copper per person installed, and it's below that, right? So if if you take that and you kind of bring it back up to trend and you grow GDP, you're going to have to increase Chinese yearly consumption in order to get you there. Fine. But the big wild card is India, because India is like 75% below trend line, not below China, below where India should be at its level of GDP. And what you were seeing as of a couple of years ago is you were seeing that begin to manifest itself in all of these brownouts and all of these power outages and things like that. And now you're starting to see that begin to ameliorate and begin to come back up and come back to trend lines. So if that happens, that's going to be an absolutely massive increase in demand.